Imagine waking up one morning and finding your savings vanished, your job gone, and your house worth half what you paid for it. This wasn't a nightmare. This was 2008, the biggest financial meltdown since the Great Depression. Banks the size of small countries collapsed in days. Nearly 9 million Americans lost their job, and the global economy lost over $19 trillion. But here's the wildest part, it all started with something as simple as buying a house. Let me show you exactly how it happened. Hey everyone, welcome back to the channel. Today we are breaking down 2008 financial crisis, what caused it, who profited, who paid the price, and the lessons we still haven't learned fully. If you're new here, hit subscribe and that little button, it helps the channel grow. All right, let's get into it. To understand 2008, we have to rewind to the early 2000s. After the dot-com bust and 9/11, the Federal Reserve slashed interest rates to nearly 1% to keep the economy moving. Cheap money flooded the system. Now, if you're a bank, low interest rates are bad for business. Owning a home has always been part of the American dream. And in the early 2000s, that dream went into overdrive. Home prices kept rising 5 to 10% and even 20% per year in some cities. Everyone wanted in. People stopped buying homes just to live in them. They bought them as investments. Flip a house and make a fortune. The thinking was simple home prices never go down. That single belief, that one wrong assumption, is the seed of everything that followed. Eventually, banks ran out of qualified buyers. Most people with stable jobs and good credit had already bought homes. So banks started lending to people who normally couldn't qualify. These are called subprime borrowers. Folks with bad credit, no down payment, sometimes no income verification. There were even loans called ninja loans. No income, no jobs, no assets. I'm not making this up. Imagine giving someone $400,000 loan when they can't prove they have a job. Why on earth would a bank do that? Because banks weren't holding those loans anymore. They were selling them. Think of it like a pizza. The bank gives you a mortgage, that's one slice. Then they bundle thousands of mortgages together into a giant pizza called a mortgage backed security or MBS. Investors all over the world buy slices. The pitch was even if a few homeowners stop paying, most will keep paying. So investors still get steady returns. Sound smart? Then they got greedy. They started mixing subprime mortgages, risky slices, with safer ones. And the rating agencies still stamped them AAA, the highest possible safety rating, the same as US government bonds. It was financial alchemy, turning lead into gold on paper. Then came CDOs, collateralized debt obligations. These were even more complex. Banks took the leftover risky mortgage slices, repackaged them into new securities, sliced those up, and sold them again. Some banks even bet against the very products they were selling to clients. Goldman Sachs famously did this. Pension funds, retirees, school districts, they all bought this stuff thinking it was safe. It wasn't. It was a ticking time bomb. By 2006, home prices peaked. They started falling. And remember, the whole system was built on one assumption prices always go up. Once that broke, everything broke. Subprime borrowers couldn't refinance. They started defaulting. Foreclosures exploded. Suddenly, those AAA rated MBS and CDOs were worthless. Banks holding billions in this stuff realized they were sitting on toxic waste. March 2008, Bear Stearns, an 85-year-old investment bank, collapsed in days. JP Morgan bought it for $2 a share. A year earlier, it was $172 a share. The government helped broker the deal. People thought, okay, we dodged a bullet. But beer was just the warm up act. September 15, 2008. Lehman Brothers, a 150-year-old institution, files for bankruptcy, the largest bankruptcy in US history. $600 billion in assets gone overnight. This time, the government chose not to bail them out, and the entire global financial system started seizing up. Banks stopped trusting each other. Nobody knew who was holding the toxic assets. Lending froze. ATMs nearly stopped working. To stop bleeding, the US government passed TARP, the Trouble Asset Relief Program. $700 billion to bail out the biggest banks. AIG alone got $182 billion. Critics called it socialism for the rich. The banks that caused the crisis got saved, while ordinary people lost their homes. Nearly 10 million American families were foreclosed on. Almost 9 million jobs vanished. The S&P 500 lost half its value. The recession officially lasted 18 months, but the pain lasted years. Trust in banks, in government, in the system itself all shattered. Movements like Occupy Wall Street were born from this only. New regulations like Dodd-Frank tried to prevent a repeat. Some helped, others have been quietly rolled back. And here's the wild fact. Only one Wall Street executive ever went to prison for the entire crisis. Just one. So, what did we actually learn? First, when everyone says this time is different, it usually isn't. Second, when risks get hidden under fancy names, it doesn't disappear. It just gets passed around. And third, when the system fails, ordinary people pay the price while the architects often walk away. If this video helped you make sense of 2008, smash that like button and subscribe for more breakdowns like this. Drop a comment. What topic should we cover next? Thanks for watching, and I'll see you in the next one.